This is Pete Moore at Integrity Square. Hope all is going well with everyone as we hopefully return to some level of normalcy, hopefully in Q1 2021. I've been working in the industry for 21 years, worked in investment banking at DLJ, worked at Brockway Moran & Partners, the private equity owner of Gold's Gym International. And then for the last 15 years, I've been doing mergers and acquisitions in the space, private placements, and I'm here to talk to you about the current environment and what we see happening over the next 3 to 6 months in the health club and boutique fitness sector. So from a standpoint of Integrity Square, we've been around since April 2010. We last year did 4 Orange Theory transactions. I worked with a lot of big regional operators on bringing in private equity capital. In addition, we have worked with management teams buying assets in the space. So we've defined the industry as the halo sector. Instead of the health and wellness industry, we call it the halo sector, health, active lifestyle, outdoors. We run Halo Talks, which is a podcast, and Halo Academy, which is a business school class. So, current environment here is, I believe, the first 90 days of COVID, there was a lot of empathy in the system. The debt providers to the industry were giving people forbearance agreements, hoping it was going to be a 90 to 120-day shutdown. Landlords were basically saying, hey, I won't send you a default notice, and let's see how things go. But I would say as of October 1st, the gloves are off in every category. Landlords are getting more aggressive with tenants. They're sending default notices. They are starting to evict tenants that have not paid. I'd say about a third of the landlords across the country are cutting deals where there is rent forgiveness for the period of time that they were closed. There's a third of the clubs that are negotiating some type of arrangement where the rent is either fully deferred or there's a percentage of revenue that was in line with what February lease or rent triple net lease was to revenue, and try and get out of the next 6 months together as partners. I think you're going to see probably 20 to 25% of all of the bricks and mortar companies across the industry probably permanently close. Maybe some of them will close, go through a bankruptcy, and then reemerge and go back and actually take some of those locations. On the high volume, low price side, I think Planet Fitness is in pretty good condition to weather the storm, and I'm assuming that storm is going to last, unfortunately, until April 1st for our industry, when we return to some semblance of normalcy. And if you are an HVLP 2.0 player, or you're a private equity-backed player in the space, I would hope over the next 6 months, prices start to rise. Promotions are done based on cleanliness, based on getting people results, and not based on price, because I don't think people are joining clubs right now strictly for price reasons. On the boutique side, in the Northeast and some of the areas of the market where the political environments are 25 to 33% capacity constraints, you're going to see further bankruptcies in the space. So I'm going to talk a little bit in the next few minutes about, the word bankruptcy has always been deemed somewhat of a 4-letter word, and it's actually a way to protect the business, clean it up, and reemerge, albeit the equity owners of the business might not have any value at the end of the day. The other creditors and the debt providers will live to fight and see another day and make something out of their investment. But the boutique space has gotten hit very hard. I think a lot of franchisees who got into this industry thinking it was going to be a passion project were not prepared to go through a pandemic, not as if anyone was, but I believe some of these smaller franchisees in the franchisor community that are doing less than $50,000 a month per studio in revenue are going to find it very hard to continue to stay active in the current environment. From a standpoint of, if we kind of use an analogy and say, okay, we've got a football game, I originally assumed that and had been advising, entrepreneurs like some of the groups that are probably listening in on this call, that April 1st is the new deadline to basically hibernate and be in a position to last through that date. I don't see traffic flows going much past 75 to 80% between now and April 1st. Getting from where we are with the fans and the players and getting to the other side. If you're negotiating with your banks for forbearance agreements and deferred interest, I think all of that's going to come to a head over the next 60 to 90 days, and some banks will be very aggressive and take over the businesses. Landlords selectively will try to evict people. If you can get a deal with your landlord and give up your security deposit and retrench your position to a smaller set of clubs, I would highly recommend trying to maintain your core nuclear base of your business and not try to hold on to locations, because I do believe that in 6 to 12 months you will have a pick of the litter from a standpoint of opening up 15 to 25,000 square foot facilities across the U.S. in empty boxes that were health clubs or fitness studios before, in addition to other big box or mid box retailers that will have vacant properties. From a standpoint of just understanding, a lot of the landlords in the sector here over the last 10 years are institutional owners. So you have real estate investment trusts, or we're called REITs, REIT. They have brought in capital into their businesses to buy commercial properties and take those commercial properties and provide a fixed income stream for the investors that are looking for a quarterly dividend. So if you're negotiating with a family that owns a building for a long time and doesn't have any debt on that business, you will probably be a lot better in your negotiations, as they want to keep you as a tenant and probably don't want to have to go through a period where they don't collect any rent and that there's not a logical new tenant to bring in there. But on the real estate investment trust side, they're playing with institutional money that's owned by pension funds and high net worth investors and endowment funds, and they are going to fight tooth and nail to try and get as much rent as they can without you as an operator filing for bankruptcy and putting them in a position where their leases could get rejected. We see a number of groups right now trying to renegotiate these leases. A lot of these groups are private equity-backed companies that are trying to put in a force majeure clause. That force majeure clause includes that if there is a second shutdown, or if I do not have access to the premises of my location, I will not be paying rent for that month. That is a key legal term that people should put into all of their leases on new projects for the next 25 years. There's no reason to take this kind of risk again. And then the question is going to be, if you do give up some locations, the locations that you'll be able to move into, I believe you're going to see 30 to 50% rent reductions across the board. Some people think that's too aggressive. I believe it's going to happen just based on the supply demand and what we're seeing in some of the big cities with other retailers going out of business. But just to give you a little flavor for some of these REITs that I'm talking about and the reasons why they're not accommodating much of the lease forgiveness or rent abatement requests. They run their own public company. They file every quarter who's paying. As an example here, Realty Income has LA Fitness with 52 of their leases, Lifetime with 14 of their leases. They also own some other health club properties. So, these companies, they've got Walmart, 7-Eleven, FedEx, all those clients are paying their rent. So, when you deal with a REIT, understand that you're dealing with a sophisticated institutional investor, and they've got their own stakeholders to pay. So just understand the difference between talking to a local owner that you'll probably get some accommodation, and a REIT where you might have to go a legal route of going through bankruptcy to reemerge and not have to pay them when there's no cash flow to pay them. What's happening in the space right now, and the basis of this is, how does private equity view the health club industry? If I harken back to the 1980s, Bally's Fitness and European clubs, Australian Bodyworks, there are a number of clubs out in the markets that used to collect paid in full memberships and turn into some pretty bad bankruptcies along the way. So when I was pitching to private equity, and 15 years ago, you used to have to always say, hey, this is how this company is different than Bally's, where private equity used to say, oh, health clubs are the place to go if you want to lose money. So over the last 10 years, we've been able to kind of rectify and disprove that myth by having a lot of successful private equity firms in the sector. Unfortunately, what's happened with COVID is it's created a level of insolvency for a number of groups that are harnessed with institutional debt payments that they need to make, in addition to landlords that demanding rent. So 24 Hour Fitness, that company always had too much debt on it, $1.4 billion of debt, and there was about $1 billion worth of equity that was lost in the 24-hour transaction. That's going through a bankruptcy process right now. During bankruptcy, they will shed some of their leases that they view as above market or in undesirable places, and the landlords there will basically get the keys back, potentially get their equipment that's actually in the location as well, and the landlord will be responsible for re-renting that location. LA Fitness, is the 800-pound gorilla in the space. You'll see on the left-hand side here, this is where the pricing of their debt is. So debt's traded for these companies just like equity is traded on an E-Trade account between institutions that want to own the debt. LA Fitness, we think, is going to be okay, but still their debt doesn't trade at 100 cents on the dollar. New York Sports Clubs was the most recent black eye effectively to the industry, unfortunately, with them going through bankruptcy protection, but they have a group that is looking to take it into bankruptcy, provide a debt dip financing, which is a debtor in possession, which is basically a senior loan to the company. And they were going to downsize to 66 clubs, get rid of most of their debt, convert some of that to equity, and hopefully come out as a stronger company. Equinox, which is a company that's probably you would view as one of the poster childs, if you will, of the industry, has got a lot of debt and is clearly affected by being in high density urban areas that have COVID restrictions, as well as just behavioral changes that are happening where populations of urban markets might not be that interested in rushing back to the club and have other alternatives potentially with their own home gyms or comfortable working out outside or using apps. So we'll see what happens there. Planet Fitness, as I said before, I think is in good position just given the low labor, the relatively low rents that they pay, and the fact that there are equity groups that are in there, as well as debt groups that are all confident in the business model going forward. So I put a little car wash on the right-hand side here. I believe that's a Chevy Tahoe. That Tahoe is going through a car wash. So think of a bankruptcy more as a car wash than a bankruptcy. Chapter 7 is basically a yard sale, if you will. So Chapter 11 is kind of going through a car wash. You get rid of all the bad leases, you get rid of the debt, and you basically hit F9 on your computer and you reset the company, and you hope to live to see another day. So the bankruptcy courts are something that if you're an independent operator and you feel like Luke Skywalker in the trash compactor of the first Star Wars movie, you should seek bankruptcy counsel. because you may be able to protect all of your assets, give yourself a little bit of time to breathe, and then better work out arrangements with your landlords and with your debtors. Once you go into bankruptcy, you're basically, to give another analogy, if we're playing tag and you're holding your hand on the pole, you are basically safe. I can't get you out. So bankruptcy used to be a bad word. Chapter 7 bankruptcy is a bad word because you're basically dissolving the business. Chapter 11 is basically I'm in freeze, I'm in hold. I get time to work everything out, and hopefully I'll come out the other side. So private equity groups are not apt to do this. They don't like taking companies into bankruptcy, but given the circumstances, I think bankruptcy court is going to be used by more and more operators. And if you are concerned about bankruptcy from a PR news standpoint, the news cycles now are 24 hours in length. So use the bankruptcy court, and people are going to forget that you ever went bankrupt, and you're going to come out the other side. So you look how the industry's evolved. I think you're still going to see, this was back in '99 when I first started in the industry to 20 years forward. Planet Fitness obviously has had the most disruptive business model in the space. I think you're going to see continued private equity interest in the Planet Fitness franchisee network. You're going to see the HVLP 2.0, whereas we're up by Crunch, Blink, and some of these other concepts like EOS and Vasa, I think will reemerge from COVID in a very strong position. I think the middle market is going to continue to get squeezed. And on the high end, I think you're going to start to see more and more traffic going into places like a Lifetime or a Fit Athletic or a Bay Clubs, because I think people in the suburbs are going to start to use their health club memberships more in line with what country club memberships were 25 or 30 years ago, because there's not going to be as many family vacations, and they're going to want a safe place, and they want to have the security of knowing where people are and where the kids are. So I think the low end 2.0 and the high end is the best areas to be in. I think you're going to see private equity come back into all those markets, but I think right now you've got a lot of private equity that says, you know what, let me wait until there's a vaccine, or let me wait until the light at the end of the tunnel I can see is the sun. It's not an oncoming train. There's a lot of investors that have gone into the HVLP 2.0 space. I think from a standpoint of these groups that are listed here, they're all in strong financial position and will be able to work their way through. I think from a standpoint of, thinking about the opportunity here, I wouldn't encourage anyone here to start going and signing up too many new leases if you're still running in the red in your current locations. I think what I've learned over time here is that patience might be the path to perseverance, and perseverance will lead to a life that you want and a business that you want. So I would be window shopping for locations, but I would not be doubling down on any locations. Also, you have a risk of what the political environment or constraints may be, as you've seen in Toronto. They closed up again, and in the UK and Europe. So somebody asked me the other day, how long can you operate at break-even levels? I say you can operate at break-even forever. So if you're at break-even, just wait and continue to do the right things. Your members will come back, but right now, do not feel that you need to accommodate your full corporate overhead, unfortunately. And there's a phrase that the lion eats first. So the lion is your company, and make sure your company survives. On the group exercise, I think you got to do what you can do on the digital. There's obviously a lot of digital players out there that I'm nervous about taking away some of our memberships, but I think the vast majority of health club members will be back. And then you take a look at the valuations here. I'm happy to share this. I think these valuations will come back, and in 12 to 24 months, the industry will come back as a stronger player. So hibernate, stay alive, talk to private equity, be careful about the deals you do, and thanks for your time.